Hi, everyone, and welcome to the Startup Success Virtual Conference brought to you by SCORE and FedEx. This webinar is the Financial Dashboard, your key to small business success. My name is Samina, and I'll be the moderator for this presentation. Our presenter is Dawn Fotopulos, Professor of Business at the King's College, founder of Hidden Profit Academy, and award-winning author. Before turning the session over to Dawn, I'd like to mention just a few housekeeping items. This webinar will last 45 minutes, and it is being recorded. A link to the recording and slide deck will be emailed to all participants. You can also download the slide deck through this webinar platform. At the bottom of your screen, there are 7 round icons, and the slide deck can be downloaded from the third icon. It's labeled Slides. We have set aside time for Q&A at the end of today's presentation. If you have any questions, please submit those using the Q&A box on the left side of your screen. And if you experience any technical difficulties, please use that same Q&A box for assistance. Now we'll begin the Financial Dashboard, your key to small business success. Thank you so much for joining us today, Dawn.
Samina, it's such a joy to be here. Small business success. Oh my goodness, what the heck does that mean? Well, small business success really means that your business stands on its own 2 feet. It supports both itself and it also supports your personal life. Having enough cash flow to support both the business and your personal life is really what we're after. And we're so excited to be part of this great initiative with SCORE and FedEx, and we want to thank them publicly. Now, most people know that if FedEx was a commercial airline, it would be the largest airline in the world, but what they don't really know is that FedEx has a spectacular ground game, and they are incredibly competitive when it comes to pricing. If you have a perishable item, if you have something that is breakable, not only will they ship it for you internationally and help you figure out how to do that, but they have a packaging lab that can design a package just for you. And as far as I know, they're the only shipper who will do that. So we are really thrilled to partner with FedEx, and we thank them for underwriting this presentation, and also the SCORE organization that does a fabulous job of producing these. This is the third of a series of webinars that we have done with both strategic partners. And in a minute, I'll tell you the other places that you can find the links to the previous webinars. But Dawn Fotopulos, I have a crazy Greek last name, is on a mission. I am on a mission to double small business survival rates because I just can't stand on the sidelines and watch really smart, creative, hardworking people fail, not because they're not capable, not because they're not willing to make the sacrifices, because they don't know what we're going to talk about in this particular presentation. I actually am a full professor of business at the King's College. That happened recently. And I'm the author of Accounting for the Number Phobic, a survival guide for small business owners, which won Best Business Book several years ago when it first came out. But a number phobe is basically somebody who is terrified of numbers. And so if you are not alone. And a lot of people will say, yeah, I need to know my numbers. It's like cod liver oil. You know, I know it's good for me, but it's just so awful going down. But we're going to make it really fun, and we're going to make it really easy. And within the next 60 minutes, you're going to learn what 99% of your peers have never learned. And it has the potential anyway to change your future. So the other 2 SCORE webinars that are pre-recorded, available to you at no charge, are on the SCORE.org website. The first is called The Power of Pricing. And did you know that most small business owners leave money on the table because they don't know how to price their products and services, and their bias is to underprice what they do. So that is a spectacular presentation, not because I gave it, but because there's a lot of important information in there, not just about how to price your products, but how to discount them and promote them without putting your profitability on life support. What you should stop doing to stay sane is another webinar, which will lift some burden off of a small business owner's shoulders. Everybody's always saying what you should do more of, and it really can get overwhelming. So what we actually do is we unpack what are the 5 things that you're probably doing that's wasting time and wasting money, And we sort of lift the burden from your shoulders in that webinar. And we got very, very good responses to that. Again, go on SCORE.org and you can get access to these 24/7. Those lovely ladies that you see in the frame with me are engineers. They're bridge engineers. They're amazingly creative. And I met them through the Inner City Capital Connections Conference, also sponsored by FedEx. And it was just such a joy and a privilege to get to know them. And so I'm thrilled to be able to show you what we did together. But at any rate, did you know that if you learn how to read your financial dashboard, not only are you ahead of 99% of small business owners out there, because most cannot, but most businesses fail not because they don't have a great business model, not because they're not doing a great job at what they do. They think, well, if I work hard enough and I do a great job, the business is going to take care of itself, but it doesn't work like that. You have to manage profitability. You have to manage cash flow, and you have to manage net worth. And we're going to show you how to do that. And the great news is we're not going to teach you how to be a CPA, because that's not the point here. Your financial dashboard, you know what it is? It's your spouse. It's always talking to you, but can you hear what it's saying? And the truth of the matter is, if you can read your financial dashboard, again, a new metaphor, it's a mirror to your business. If you can look into that mirror and understand what it's telling you, you're going to make better business decisions, and you're going to avoid a lot of the traps that a lot of your peers are getting into. So let's talk about that for a second. Accounting for the Number Phobic, this is my book, and I wrote it for one important reason. I wanted to use humor and metaphor and stories to take what really is a dry and brittle topic and make it reachable and approachable for people just like you. The gentleman who illustrated it is a Disney artist. And so we have little elves all throughout the book doing various things. But the whole idea here is that it's everything you needed to know before you opened a business and just never learned. And if you take a look at Amazon, we have, 100 or so comments on there from people who found the book. I'm not exactly sure how, but they did. And they read through it and said, holy cow, why didn't I have this book 20 years ago? So the reason we're doing this webinar is, instead of you being in the desert for 20 years trying to figure this out on your own, we want to get you started on the right foot. And that's what's so exciting about this small business success webinar. So the book is just a resource to you. Okay, so the question really remains, what's the problem? How come all these smart people are failing? And I want to show you a schematic that took me about 18 years to figure out. But it's like looking through a camera lens. When I finally saw the dynamic, it clicked in my head and it made perfect sense. So what typically happens is, if a small business owner has trouble paying their bills, they tend to have the same kind of knee-jerk response. It's always the same default response. I'm going to grow my way out of the problem. Now, in theory, if you have a problem and you grow that problem, all you're really doing is growing the problem. You're not growing a solution. But it doesn't matter. Most people think, I'm going to grow my way out of the problem. I'm going to grow my business. And the way I'm going to do that is I'm going to discount my prices so I can close more business. And that's the primary way a lot of people acquire new customers. They're not looking at their existing customer base. They're taking on new customers. And when they do cut their prices significantly, what they're doing is they're destroying gross margin. And in a minute, you'll understand why that's so toxic. And you run your business on gross margin, not on sales. And that's, again, we're going to go through that in a second. But you destroy gross profit, because from there you get to pay all your bills. When you destroy gross profit, you also destroy your bottom line, which is your profitability. And now what you've effectively done is you've attracted new customers, right, that are paying you less money. You're working harder because now you actually have more work you got to get done, and you're getting less for it. So we call this the doom loop, because a lot of people are doubling down on bad strategies. That's what this is. And your profits actually go down with the strategy, not up, which is what you really want. So the question remains, well, how do you get out of the doom loop? The first thing you have to do is you've got to understand your financial statements, because they're going to show you what's going on in your company. And you know what they are? They're like health checks at the doctor. You're going to check your pulse. You're going to check your heart rate. You're going to check a whole bunch of things. And that's really what your gauges or your financial dashboard helps you do, to say what's working, what's in good shape, and what really isn't, and what do I need to attend to, and how do I do that? So we're going to cover that in today's agenda. So we're going to teach you how to read your financial statements. First of all, we're going to define what those are. If you have ever watched Shark Tank, if you've ever watched The Profit, they all say the same thing, all of them. The investors all say the same thing. They say, you don't know your numbers. But what they don't do in the show is they don't define what those are. We're going to define them. And those numbers are basically hidden in your income statement, your cash flow statement, and your balance sheet. It's not more complicated than that. It's essentially 3 statements that they are talking about. And you're going to determine if your business is making enough profit, if you're generating enough cash flow to pay your bills, and whether you're building wealth or destroying it. So everybody who is on this call, whether you are starting a new business or you're actually running a business, I want you to ask yourself these 3 questions. These are the 3 most important diagnostic questions every small business owner needs to answer, and you need to answer it cold. You need to know this without having to scramble around to get the answer. You should know this on a monthly basis. Are you making a profit? And if you are, how much are you making? And if you're not, how much are you in the red? Second question, is there enough cash to run the business, not just for today, but for the next 90 days? Do you have enough cash for the next 3 months? And if you don't, you're probably like 90% of the 21 million small business owners that have less than 30 days of cash on hand. And that comes from the Gallup company. And I got to tell you, that's not a problem. It's an epidemic. So you got to have enough cash on hand to pay your bills for 3 months. And then the third question is, are you building wealth or destroying it? And your 3 financial statements are going to help answer those questions. So let's take a look, first of all, at what your financial dashboard looks like. And this is one of the illustrations from Accounting for the Number Phobic, and it looks like your car dashboard. And most of you drive cars, and we know what a dashboard looks like. And we have these gauges for a reason. The gauges give us information. It doesn't tell us what to do if the cash flow gauge, right? If our gas gauge is on empty, it doesn't tell us to go buy gas. We know instinctively that if we don't, we're going to have real problems, right? But those gauges are important because it tells us what's going on under the hood. It is exactly the same with your business. So the 3 gauges, again, are your net income statement, which will measure your profitability and how fast your profitability is being generated. Your cash flow statement is going to tell you how much gas you have in the tank, right? How far you can drive before you have to refill the tank, before you have to get more cash to flow through the business. And then your balance sheet is your net worth statement. So if you just look at these 3 statements, it feels a lot less complicated. And I'm going to take you through it one by one. Okay, so let's do that. So net income, right? That's essentially your speedometer. Are you showing a profit? If your net income is positive, then you're making money. Okay, you know this kind of instinctively. Your net income is your bottom line. That's after you pay all your bills, you paid your suppliers, you paid interest on your loans, you paid taxes. That's what's left over on your very, very bottom line. And frankly, friends, that's why you're in business. Okay, you're not in business to generate sales and to pay everybody and then to have nothing left to show for it. If your net income is negative, it means you're showing a loss, and you know that instinctively as well. Now, here's the deal. That's an unstable situation, and you can actually live in an unstable situation for a short period of time, but you can't live in that long term. So if your net income is negative, you got to figure out why, and then what are the options to fix that. And then last but not least, break even is when your net income is 0, and what that essentially means is that your income coming in and your expenses going out are exactly equal. Now that sounds like, oh, well, that's an okay situation, but it really isn't, because as a business owner, you're taking on a tremendous amount of risk. You need to be generating a positive after-tax bottom line. And I'm going to give you a number nobody will ever give you, but it operates, and we need to manage to this. According to Greg Crabtree, who's a very smart CPA, and he has a great website called simplenumbers.me, like Mary Eddy, right? He says, For every dollar you bring in sales, you need to be generating 15 cents on your bottom line in order for you to have a business that will thrive. So let's take a look. Here's a little example. That lovely young lady who's wearing that pretty t-shirt, that actually is a t-shirt made by the very first company I ever owned, called Bedazzled Incorporated. And that young lady was one of my students at the King's College, and she's sporting it at the beach. So let's make believe that you are the owner of Bedazzled and you make that lovely screen printed t-shirt, and we want to know how much have you generated in revenues. And your revenues are always your top line. And here's the great news. It doesn't matter if you're running General Motors or if you're running the corner candy store, it is exactly the same. We start with the top line, and that's revenues, and for our purposes, that's sales. So you sold 1,000 t-shirts, you sold each one for $10. Your revenues are, drum roll please, you just multiply those two numbers together, it gives you $10,000. Now, it sounds great. And if you want to take a nice big trip to Brazil, it sounds like you can take that 10 grand and go have a good time, but you can't, because there are so many other expenses you need to pay before you go take that Brazil trip. You got to pay your suppliers, you got to pay your fabric fabricators, you got to pay your screen printers, and so on. So the question is, where does this revenue number get captured? And it gets captured on the top half of your net income statement. And here's something to remember. When you hear the term net income statement, when you hear the term income statement, profit and loss statement, or P&L, they're all referring to exactly the same thing. They're all the same thing. It's all shorthand for this particular statement. So the very first number on your top line is that $10,000. That's where it goes. But then it costs you money to make that t-shirt, like I was telling you, right? You have to cut it, sew it, screen print it, and so on. So in this case, it's $4,000 to make and fabricate those 1,000 t-shirts that you just sold for $10. If you take the 4,000 away from the 10,000, that's what you end up in gross margin, which is $6,000. This is a very important number. Nobody ever looks at this number, but this is the number on which hinges your success as a small business owner, okay? Gross margin, gross profit, or margin are all the same thing. And in essence, what this is this is the premium over and above what it costs you to make those t-shirts. This is the premium that you get because you're taking the risk, you're doing a great job of marketing, and everybody loves your t-shirts, just like Breckley in that lovely picture that you saw, and they use it for beach cover-ups and so on, but you made $6,000 on those 1,000 t-shirts that you just sold. That's the top half of your P&L. So let's just do a little review. Your revenues are net revenues, which means they're revenues less any discounts. So sometimes you'll offer a slight discount for a variety of reasons, a large customer, or they pay early, or whatever the story is. But remember, you don't run your business on sales or revenues. You run it on gross margin. Why? Because it is from gross margin that you pay all your other operating expenses, and there are tons of them. It costs a lot of money to run a website. It costs a lot of money to market your goods and services. It costs a lot of money to pay insurances. If you have employees, right? Even if we hire subcontractors to do logo design and web design and all sorts of stuff, those are real expenses. So all expenses come out of gross margin, and so therefore, the higher your gross margin, the easier it's going to be for you to pay your expenses. So the game is won in improving gross margin. So let's just take a look at it visually. Okay, what your revenues are, think of your revenues or your sales as like a great big pile of money. And then you pay your cost of goods, you pay your suppliers, right? Your fabric guy, your screen cutter, and so on. You pay them, and then here's your gross margin. And what we're basically arguing for is that for every dollar of net revenues you bring in, your gross margin needs to be about 30 cents. Now, I have a guy who's arguing with me on LinkedIn. It's actually quite funny. And he says, well, you know, if you turn your inventory 100 times a year, you know, your gross margin doesn't have to be that high. And he's right in theory. But the only people that I know that turn inventory 100 times a year are people that sell ice cream. So if you're not in the ice cream business, use this as a benchmark. But what you should do really is find out what are the gross margin benchmarks in your industry because it's going to be different. If you're in a service business, it's going to be different. If you're in a product business, it's going to be different. And your accountant can help you figure that out. And also the librarian in your local business library can help you figure that out. And guess what? Your SCORE office, your mentor there, can help you figure that out. So net revenues is 100%, and everything becomes a percent of net revenues. So this is the top half of your P&L, and we just showed it kind of graphically. So how do you increase gross margin? If it's a gross margin game, and we win at the game by improving gross margin, how do we do that? Well, we can increase unit price, but you really need to watch the Power of Pricing webinar because we're not going to go into all the different ways to do that. You can't just sort of stick your finger in the wind and raise price. There is a strategic way to do this where you can actually raise price and not lose sales. And we talk about it in the Power of Pricing webinar. You really, really should watch that. It is so worth your time, and it won't cost you anything. But you increase price if you increase value, or you find a new target audience that wants to pay a premium for what you do, in short. So if you sell more units for more total gross margin, another way to improve gross margin is to reduce your cost of goods sold. Remember, that's one of your key expenses. And there are a variety of ways that you can do that. We're not going to go into the details right now, but let me give you 4 bullets on how to do that. You can reduce your direct materials expenses by re-engineering the product. We didn't have to use 100% cotton. We could have used cotton and polyester, which would have cost us less money per yard. You can reduce your direct labor expenses in making the t-shirts so we would become more efficient, right? We can also reduce cycle time, particularly in service businesses. If it takes you less time to install a granite countertop than your peers, then that's a way of improving your gross margin because your time is really your cost of sales, right? Or if you reduce errors in production, that's a very, very big deal. If you reduce errors in production, that also reduces your expenses. Okay, so once we determine what our cost of goods are, we get to gross margin. Now there are operating expenses after that. We're not out of the woods yet. We can't just take those that gross margin and then go off to Brazil. What are the expenses? We have expenses where we talked about cost of goods sold, which is direct labor and direct material. That's above your gross margin. But then there are fixed and variable expenses. An example of fixed expenses would be like rent and insurance. And the reason they're called fixed is because it doesn't matter how much you sell or don't sell, you still have to pay your rent. Variable expenses tend to fluctuate with the volume that you sell. So marketing and payroll tend to be variable expenses, and they're significant, by the way. And so we need to keep an eye on those. And then you have to pay your taxes. Now, if you do business in New York City, you know what? You got a lot of taxes. You have to pay city taxes, state taxes, and federal taxes. So taxes are significant. And here's the great news. Once you get through all of these various cost categories, you get to earnings before taxes, then you pay your taxes, and then you get to net income. So let's just put it all together and take a look at a visual, a simple visual for Bedazzled Incorporated, okay, for the t-shirt company. And you know what? It doesn't get a whole lot more complicated than this. So even with the very big companies, they may have more line detail, but it's essentially this structure. So if you want to know if you're making money, here's how you find out. We start with the revenues of $10,000. We took away $4,000, right? Because we don't get to keep all that $10,000. We had to pay our suppliers. These are direct costs. These are the costs that are required to create that finished product, that lovely t-shirt that you saw in the picture earlier. And then we're left with $6,000. But again, we're not out of the woods. We have operating expenses. We had to pay our rent for $2,000 and insurance. We have some variable expenses in this example of $2,000 as well. And we take $6,000 where we start with gross profit, and we take away an additional $4,000. We have earnings before taxes of $2,000, but we still have to pay our taxes. In this case, it's 50%, which is high, but it's not uncommon. And then, drum roll, please, we end up with net income of $1,000. Now, if we did a ratio and said, okay, what percentage of revenues is net income? This is easy to calculate because all we do is take $1,000, divide it by 10,000, and we end up with 10%. 10% drops to our bottom line. Net income is your bottom line. Now, we're not quite where Greg Crabtree wants us. You should be at 15%. And then what happens is we have enough of a buffer that if some of these operating expenses or some of our cost of goods increase where we don't have any control, the cost of cotton goes up, the cost of minimum wage goes up, whatever the story is, we have a buffer down here where we can survive those challenges, okay? So just remember, 15% net income to revenues is what we're after. So we want to compare revenues to expenses all the time because we don't want expenses to get out of control. So the ratio of revenues to expenses is important, and we ask this question of every dollar of revenues we bring in, how much of that drops to the bottom line? So here's an example in the real world. If you want a grocery store, a typical grocery store, did you know that for every dollar they bring in, only a penny and a half drops to the bottom line? I mean, when I heard that statistic, I was blown away. And I was tempted to get down on my hands and knees and kiss the ground that there's somebody out there that wants to take on all the shortage problems, all that fixed expenses, all of the employee issues and whatever, so that you and I could put dinner on the table in a half an hour. But a grocery store bottom line is actually quite low. So the question on the table that you should know the answer to, and if you don't, go to your SCORE office and ask them to place you with a mentor. You could also do this, by the way, online. And in a minute, we'll take you through where to find those links. But what is your industry norm for your industry? You should know what those benchmarks are so you know what you're managing to. Okay, so are we making money? Are we making money? The second question is there enough cash to pay your bills? So did you know that you could be showing a profit on your net income statement and still be going bankrupt? That is a true statement that nobody knows. So we got to look at your cash flow statement because cash is to your business as blood is to your body. Okay, I'm going to say that one more time. Cash is to your business as blood is to your body. Super important then that we can focus on and measure our cash flow at any point in time. It's kind of like your checkbook. There's a little bit more detail than that, but that's sort of what it is. Your starting cash, your cash in, your cash out, and then your ending cash. So it's obvious to say, well, if it's like my checkbook, then why don't I just use my checkbook instead of my cash flow statement? Because cash flow also adds back in things like depreciation expense, and it also helps you figure out what the timing of when you get paid and your expenses out the door. So your cash flow statement gives you more visibility simply than your checkbook. So most small business owners will look at your checkbook. It doesn't give you enough information. So we talked about the 3 gauges earlier, remember? And your cash flow statement is a lot like your gas gauge. It tells you how much gas do you have in the tank, how far you can travel, and how long you can run the business without needing more cash. Now, there are 3 sources of cash for any business, and it doesn't matter how big or small your business is. You can get cash flow from operations. You do a job, you invoice the client, you get paid for that job. That's what's called cash flow from operations. That's your premium fuel. You earned that. You don't have to pay it back. You earned it. That's why you're in business. You can also get cash from a loan. And the only time you should take out a loan is when you're going to get a return on investment for that loan capital. In other words, you have an order in your hand, you have to finance the fabric, and you have to finance the screen printing, but Lands' End has already written you a purchase order, and now you need to finance the ability to actually fulfill the order. That makes sense. And then last but not least, investors, right? But investors are very demanding. They want a 200% return on investment within 24 months. And so it sounds like things are great when you're on Shark Tank and you get the investors to show up, but it puts a lot of pressure on the system. So if you get a loan or you get investors, remember that's money that's not yours. You got to pay that back. So the bottom line is this. No matter how much cash flow you have or don't have, you got to interpret where the needle is to figure out what the needs of the business are, not just today, but for the next 90 days. So again, your cash flow statement, what's your beginning cash? How much cash is coming in and when is it arriving? That's important because you pay your bills with cash, not with receivables. And then you subtract out the cash that has left and you end up with an ending cash position. So let's just take a look at a very simple cash flow statement, just like we did the net income statement. So if we begin with $10,000 in cash in our account, we get paid $3,000. And by the way, there could very well be a lag time between the time we sell something and the time we get paid for it. And we'll go through that in a second. And cash out, we got to pay our rent, right? We can't call our landlord and say, gee, we had a tough month, we didn't sell much. Is it okay if we don't pay the rent? That never flies. So we have to pay our $5,000 in rent. We have to pay $2,000 in insurance, and our ending cash position is $6,000. Okay, then the question on the table is $6,000 enough for us to pay our expenses over the next 3 months? Well, if we're paying rent of $5,000 a month, let's say we pay insurance once a year, we're paying this every single month like clockwork. We don't have enough cash flow to pay our rent over the next 90 days. So we need to do something about that. So remember something, revenues and cash are not the same. There are delays in payment, discounts to payment. Sometimes clients even go bankrupt. So you book net revenues when you actually sell something, but you book the cash when it actually arrives. So how do you improve cash flow? You should invoice on a timely basis. You should make sure you're on top of your receivables, so you remind clients that they owe you money. There are ways to do that, and your SCORE mentor can help you. But it's important that you build your relationships with clients so that they do pay you, and that will help keep your cash flow healthy. Last but not least, are you building wealth or destroying it? And it is your balance sheet. That's your third statement that will tell you whether or not you are building wealth or destroying it. And so how do we know? Your balance sheet is actually your net worth statement. And in our car metaphor, that's like your oil pressure gauge, right? How much liabilities do you have versus assets? So let's just take a look at that for a second. There's a wonderful article in Numberphobic that talks about how to win friends and influence bankers. And basically, it's like the net worth of your business. You have a personal net worth? Well, you know what your business does as well. It's the relationship between what you own and what you owe. So let's just take a look at how we measure that. So again, are you building wealth, destroying it, and how do you know? Let's take a look. We don't want just the salvage value of the desks and computers. We want to build a business that we can eventually sell. So let's see how we measure the value of a business, and this is your balance sheet. On the right-hand side, you can see it. There are only 3 sections, and only ever 3 sections. Assets, what do you own? What do you have title to? An asset is something that you own that you can convert into cash either within 12 months or after 12 months, but a liability is what you owe. Those are mortgages, those are credit lines, those are credit cards. And your owner's equity is nothing more than the difference between the two. So very easy equation. What you own, your assets, minus what you owe, your liabilities, that's your owner's equity. That's it. And it is absolutely possible to improve owner's equity if you can improve your asset base faster than you take on liabilities. How do you do that? You do that by generating gross margin, improving your cash collection, and taking on less and less debt because you're doing such a good job of collecting against your revenues. Okay, so this is an example of a balance sheet. Your current assets can be are either cash or convertible to cash in 12 months. Fixed assets take longer to convert into cash. In this case, total of $22K. Your current liabilities, you have a payable maybe to your suppliers, a credit line, maybe your credit card, $3,000, you owe $10,000 on a mortgage, $13,000 is your liabilities, and your owner's equity is $9,000, which is great because you own more than you owe, which is what you want. So your banker is going to scrutinize your balance sheet. Investors will scrutinize your balance sheet. You should know what it means. At any rate, increase asset values, increase gross margin, cash, and sell more. Increase your receivables. To decrease your liabilities, pay off your debt, use debt to invest in marketing so you get a return on investment, invest in assets that go up in value, always match the life of an asset to the length of the loan. So remember, your financial dashboard is your GPS for running your business. Your net income will show you if you're showing profit, breaking even, or showing a loss. Your cash flow statement, do you have enough cash to run the business, not just today, but for 90 days? And net worth, are you building wealth or destroying it? And if you understand your financial dashboard, you will reduce your risk. Now, this gentleman is just a genius. His name is Norm Brodsky, and he said the following, and he's actually an entire interview on the 10th chapter of Numberphobic, and he says the following, a business is all about the numbers. Most businesses could really make it if the owners knew the very basics of reading their financial dashboard, and now you do. Isn't that great? So a couple of things to remember. FedEx has a Small Business Grant Award contest in the first quarter of 2020. Don't miss it. It doesn't cost you anything to apply. And if you win a grant award, there's a cash award, there's mentoring that goes with that. It is an amazing program. You have nothing to lose by applying. I encourage you to do that. The SCORE Foundation has mentors. It has offices, 350 of them around the country, and you can even get access to this wonderful mentoring online. Go to score.org. And yes, you're not dreaming. Pinch yourself because it's all at no cost to you. And if you want more, you can find me at dfotopulos@gmail.com. I do answer my emails, and there is a free Numberphobic study guide that I'm happy to provide to you as my gift. So without further ado, what I'd really like to do is send this presentation over to Samina, and she will handle the Q&A and facilitate that. It's just great to be with you.
Okay, so we will now start the Q&A portion of our call, and we'll address as many questions as we can in the time remaining. If we don't have time to get to your question, I encourage you to connect with the SCORE mentor after the webinar. Mentors are available today in the mentoring hall, and you can also find one at score.org/find-mentor. So let's get started. Cheryl asks, is there a formula for how to price services such as training or written materials?
It's a very good question, Cheryl. I'll tell you what, training and written material, there is so much training in so many different industries going on. The first thing that I would do is I'd go out into the marketplace as if you were a buyer of whatever it is you want to sell and find out what at least 3 of your competitors are charging, and competitors that have your equivalent experience, your equivalent background, and so on. And if you have 3 data points, you can come up with a pricing structure that's going to make sense. Are you better, more qualified than they are, then you should charge more for it. If you're just getting started and you want to provide some sort of an easy way somebody can sample from you, do a pilot program from you, and then eventually grow that program so you can charge more, that's what I would do. But I'd start with become a buyer of your services. See who's out there, not just what they're charging, but what they do for what they're charging, and who do they say their clients are, and are those clients going to be similar to the clients that you're going to be going after? So there's so many things that go into pricing, but at least understand what your competitive framework is, and that will be helpful to you.
Okay, Joseph asks, is 20% reasonable as a gross profit?
Joseph, very good question. If you're selling ice cream and it's a cash business and you're selling 1 million ice cream cones a day, it's probably okay because it means you're turning inventory very quickly. If you're in an inventory business like selling cars where you only sell your lot once a year or twice a year, 20% is not going to be enough because your carrying charges are very high. It depends on what industry you're in, and if you don't know what the standard gross margin should be in your industry, I strongly recommend you find an accountant or a bookkeeper who's an expert in your industry who can give you some of those parameters. And what you should do is go to a website called findaproadvisor.com, punch in, it's an Angie's List for accounting professionals, Intuit sponsors it, punch in your zip code, and then you're going to get a whole bunch of people in your area. They don't have to be in your geography, but you can test to see who's got expertise in your industry, or you can put in a little box your industry, and a whole bunch of people will pop up. Look for the people that are CPAs and have advanced Intuit designation, advanced Pro Advisor designation. And you can hire them for an hour and just give you some parameters to answer that very, very good question. It's been my experience as a consultant for over 20 years that If a business does not generate at least 30% gross margin, there is a high likelihood they're having trouble paying their bills. So 20% is okay if you turn your inventory very quickly, but it's not going to be okay, especially if any of your other expenses tend to hiccup. Some you can control, some you can't. And it's always better to have 30% or higher so that if minimum wage goes up, your insurance premiums go up, whatever, you have some buffer to handle that.
Okay, and Dawn asks, can financial judgments on the personal level affect an unrelated new business venture's cash flow?
Yes, Dawn, yes. Okay, what you have to do is you've got to look at your life and your business the way a banker would look at it. So Chapter 9 in Accounting for the Number Phobic is basically an interview that I had with one of the division heads for HSBC here in New York, and she was in charge of the lending unit to all small businesses in the Brooklyn area, and it's a huge portfolio. And she said the following to me. She said, it's really astounding to me that, and she manages all the underwriters, in other words, the people that determine whether or not somebody gets a loan. She said, it's astonishing to me how business owners will assume that their personal life has nothing to do with their small businesses. And yet when we look at them as a credit risk, we always look at their personal lifestyle. We look at how much it costs them to live every month. And if we think they're living a little too high on the hog, regardless of what the business is doing, we won't loan them money. So in terms of cash flow, from a loan standpoint, your personal life and your business are all lumped together from a banker's perspective. So you need to be mindful of that. Don't go out and buy the big house and then apply for a business loan, because the bank is not going to look at you favorably if you do that. And I don't know if that answered your question, but I've seen it many times, and we don't want you to get caught in the crosshairs of that.
Okay, and Chris asks, how do we find out all the applicable taxes?
Well, Chris, I don't know what business you're in, but the one thing that I would absolutely do is, if you're trying to figure out all applicable taxes because you're trying to buy inventory from China, then you need to partner with a Federal Express that's expert in import, export, taxes, customs, and all of that stuff, because they know that information. They're geniuses at it, and they've done it for decades. The other thing is, if you're just talking about applicable taxes, you selling to a particular type of client, FedEx can help you, but your CPA who does your taxes can also help you. And you should know all of that up front, because that's going to definitely affect your financials and your cash flow.
Okay, Marie asks, how do you increase gross margin as a small business owner if the state raises the minimum wage, which means you'll have to raise the pay for your employees, and you don't want to lower the price of supply, or else you'll get low quality supply? What can you do to increase sales?
What you have to do, Marie, is you got to become a niche player. You know what that means? That means that not every customer is going to, not every potential customer is going to be your customer. And as a small business owner, you're going to be capacity constrained by definition. So what you need to do is you need to become the go-to person for fill in the blank, the go-to person who learns how to hire and place people with disabilities, the go-to person who learns how to turn around restaurants of a certain scale, the go-to person. You know what I'm saying? You can't be a commodity, because if you're a commodity, everybody's just going to look at you and say, I'll just choose the cheapest person who does what you do. But if you are a niche player, okay, if everybody looks at who's going to teach financial literacy to small business owners, I'm that go-to person. Because quite honestly, I was financially illiterate at one point, and the book is an award-winning book, and so they'll come to me, and I'm happy to be that person. You need to find out what your specialty is, what makes you unique in the world, and you got to ask the question in the reverse. Why do people come to you, your customers come to you, instead of your competition? And if that's true, then you have to learn how to charge up for what you're doing. That's how you improve gross margin. You don't compete on price, you compete on value. And it's not just what you're doing for what you're charging, but it's the entire customer experience. So if Federal Express wants Dawn Fotopulos to record a webinar on a very tight time frame, I am here for them. I'm a strategic partner for them. I will do whatever it is they ask, and they absolutely know that I will show up solid. Okay? So that's not true of everybody that does what I do. Figure out what your uniqueness is, and if you're not sure, ask your top 5 customers because they'll have the answer for you.
Okay, well, those are all the questions we have time for. And if we didn't answer your question, please work with a mentor at score.org/find-mentor. And ladies and gentlemen, on behalf of SCORE and FedEx, I'd like to thank you all for attending. And I'd like to give a big thank you to Dawn for presenting today.
Thank you, Samina. And everybody, follow me on Facebook, because what I'm going to do is ask Samina to send me your questions, and I'll answer your questions on video.
Okay, great. Well, thank you again to everyone, and have a great day.